Well, good afternoon. Let's have a check-in on the markets. It seems at this point that there's little respite for global markets at this particular point, and this is on concerns about a possible downturn. We did see stocks yesterday reaching a 13-month low in a widespread sell-off on the back of concerns that the Fed might struggle to tame some of the inflationary spirals without necessarily bringing the economy into a recession. So earlier this morning, Asian markets were a little bit lower. Hang Seng Index down about 1.8%. This is after it's come back into trade following yesterday's, public holiday. The Hong Kong listed tech sector, that was a little bit lower, with the Nikkei also down about 0.5%. We are seeing that mainland Chinese markets bucking the trend on that particular front, ending the day in positive territory. As it stands right now, European stocks are looking to rebound. U.S. stock futures a little bit higher, pointing to a higher open. And our local markets, about an hour into trade, we saw the all-share index up about 0.7%, led by the financials. But to give us some perspective in terms of whether some of the gains that we're seeing in our local markets are able to hold through, at least for the rest of the day, we are joined by Martin Smith, who is a portfolio manager at Anchor Capital. Martin, thank you so much for your time. I mean, you get to wonder why stocks were lower yesterday. We're trying to claw back some of the gains, but I'm wondering from your perspective, how's our JSE performing? Are we able to see that positive sentiment filter through to our markets?
So, for the majority of this year, we held up incredibly well relative to the rest of the world, relative to the US specifically. The Rand also stronger than it was at the beginning of the year. But what we've seen in the last couple of weeks is that real risk-off sentiment, that real kind of negativity that we're seeing in the market really filtered through into ours. So we've kind of gone alongside global markets in the last week or so with this massive sell-off we've seen. Today, we're having a little bit of a relief rally, maybe some bargain hunting. But still, I think there's a lot of unknowns. There's still a lot of risk out there, and a lot of overhangs insofar as war, inflation, Chinese lockdowns, and the like. So I think until we get some more clarity on that, I think that'll definitely be an overhang on our market as well as kind of offshore markets.
Of the economic scenarios that market participants are fearful of at this point, whether it's stagflationary fears or a recession, which of the two fears are growing louder, at least in argument at this stage?
I think the stagflation one. You saw the BOE come out last week and essentially confirm that in that part of the world. And I think people are very worried that's going to happen in the US. Look, the Fed think that they're going to be fine and they're going to be able to grow their way out of increasing interest rates and inflation and the like. Also, our base case that the US consumer, which is kind of the biggest part of the US economy, is in really good shape and will be able to keep things afloat over there. But there's definitely fears around it. I think that's what's driving a big part of this kind of negative sentiment we've seen. And until we see those US CPI numbers out, I think tomorrow, and kind of how that plays out over the next couple of weeks and months, I think people are going to be nervous.
In an environment where the broader consensus could be one of higher bond yields at the same time coupled with tighter monetary policy, and obviously having an effect right now on the tech sector, which sectors are you optimistic at this point about?
So as you know, markets are forward-looking, and I think they've been pricing in the scenario for the better part of 6 months. You can see that in the growth versus value arguments and the outperformance that you've seen from value stocks specifically over the last 6 months. But what's interesting now is that the divergence between the two is kind of now a lot less kind of obvious. So I think maybe while you'd say theoretically, still the environment that we're in, you'd probably still be going to value, but value stocks are starting to look a bit expensive now. And like I said, markets are forward-looking. So you could probably look into getting into some tech stocks now opportunistically because of the kind of carnage that we've seen in the market in the last couple of weeks.
So we had a conversation with Gary Boyson from Rand Swiss yesterday, and I was curious in getting his conviction when it comes to the mining stocks in particular, because a lot of the mining companies have made headlines, and adding ArcelorMittal to it today with a notice of possible strike action. What's your conviction on mining stocks at this point?
So yes, so you obviously saw the same news out of Sibanye last week, insofar as how that's affected the gold side of their production, and that's obviously quite negative for profitability. So that's obviously a massive headwind for those. But not all gold, so not all kind of commodity stocks are made the same. I think you've got to be quite specific in the exposure that you choose. We are quite a big fan of the diversifieds, things that have exposure to kind of base metals and coal and the like. Things that we aren't as bullish on, gold, and we're probably a little bit skeptical on iron ore. Not sure how that'll hold up depending on what happens out of China. So I think there is still definitely opportunity, but I think you need to be very specific about the company that you choose, as well as the exposure that they have to commodity-wise.
Right, Martin, let's leave it there. And of course, as Martin did mention in one of his responses, we are looking out for US CPI figures that are due out tomorrow. Throughout the day in the US, we're going to be having a lot of comments from some of the Fed presidents, whether it's New York and Cleveland. And after markets close tomorrow, we are expecting Disney's Q1 earnings. So we'll unpack all of those for you.